All righty. I want to start with something a little different. Good morning, everybody. If you haven't been here before, glad you came. If you've been here before, even better. Um, I was told about this report yesterday that the Knox brothers put together. So the Knox brothers, they're at Compass. They do an incredible job. We do some closings with them occasionally. But they put together what they call the Naples Intelligence Report. I thought it was pretty neat. They've got some cool statistics on here. You could look at this and understand a little bit about what the different levels of the market are. But what I also thought was interesting is you don't want to take things at face value either. You want to dig into the numbers and make your own determination as to what's relevant and what you determine from that data, because it's really how you present the information as much as what the information itself says. So I'll give you some examples. We look at they're detailing the different markets, high, super luxury, which is 10 million plus. And then they have the other markets, what do they say? They call ultra luxury, which is greater than 10 million. Luxury is greater than 6 million. Then they look at the golf, single family, and entry level. And they talk about what the market's done up until this point. Let's see, we'll go full screen. Hopefully you can see it a little better. So at the ultra luxury market, they believe that you've got a huge bump in interest. 71% increase in sales, 99% increase in volume, and 16% increase in average price. A plus intelligence rating, strategic positioning, they think that this is a hot part of the market. It's a low risk that you'll see a decrease in the value of your property. And they recommend acting immediately because the market is churning so quickly. Now, I wonder how much of this data is skewed by the fact that we had two sales that were like over 300 million collectively. So you had two Port Royal sales. One of them was 85 million. The other was 215, I think, right on the beach. So that jumps everything. It's like that washes out whatever a bad market might have been. Um, so I don't know how much that market is real, how much that data can be relied upon. I looked at similar information. I saw one of the brokerages posted information about the city of Marco and their sales. And they said that lot sales are way up. Not really. Lot sales are not way up. They had one sale for 6.5 million. That was it. And it skewed the numbers so drastically. Now, maybe that goes to what the Knox brothers are saying, and that ultra luxury market is starting to really pick up, because a $6.5 million lot sale means that you're going to have a $15 million house potentially. It looks like I am getting a second phone call. I have to put myself on pause. I will only be 30 seconds. I'm sorry. All right, I'm back. I'm sorry about that. When your wife calls twice in a row, you answer. All
Yeah.
right, so going back to the Knox brothers, I think they did an incredible job with this. But what I thought was interesting is you start to see the red when you go into the golf gated, the single family, greater than 4 million in the entry level. It starts to really weaken. Now, interestingly, in my experience, over the last 8 months, we didn't see a lot of the big deals. And historically we would. We had one deal that was the 10 million plus, and it fell apart. And I think that's really like, there was some market enthusiasm initially after the election. And then when, some of the administration's policies started to take effect and all the information came out, they pulled back in a pretty dramatic fashion. And I think we're still seeing the data from a lot of that. Now, over the last 6 months, we have seen a huge bump in the lower market. We're doing more deals, below 500,000 than any year in the last 5 years. I don't really know what that means. Maybe those properties are just a little bit more affordable. It's a way to get into the market a little easier. You can still get some great amenities potentially. But that's what we're seeing. We're seeing the market is moving the most at that lower market, that lower model. The 500 to a million, that's the toughest market. That's the part that we're just not seeing a lot of movement there. And then over a million, there's still a lot of interest there, but it's not quite what we want it to be, right? So let's see, we'll see what happens. But intelligence reports like what the Knoxes put together, they give some really wonderful analysis. I love a lot of the things they did, and this is super cool. So the other thing I wanted to point out was like, this is great. They're doing such a good job by just putting in the effort, making it look presentable and really, really sharp. It sets them apart in a way so their clients think, man, they're putting all this effort into understanding the market. How do I benefit using them to help us? Dad, when the NAR thing came out last year, I had one thing I was saying, which was, this is going to force us to be better.
Yeah.
This is an example of that. We're up in our game. We're making ourselves look better. So I commend them. Good job. If not everyone's going to do what they did, but your version of that, your version of putting in the effort, putting in the time, I think it's pretty cool. What do you think of the market, Dad? Do you have a vibe on it?
Yeah, I don't like these reports unless I know how many data points we have, time period we're looking at, and the demographics of the buyers, because they all have different motivations. I mean, your demographic versus mine, different motivations. It's sort of like the stock market. We have the quarterly earnings that come out, and I'm always telling your mother, this is just an arbitrary, measurement from this state to this state. Businesses don't plan their future based on quarterly
Oh, I
numbers.
love that. Yeah, absolutely.
They have a long-term view, they have a short-term view, they want to cover their expenses in the meanwhile. So it's a snapshot. Is it median? Is it average? Is it, as a baby boomers, is it Gen Z buying the stuff that's 500,000 or less?
Who knows? Um, you make a really good point. It's not about the one data point. It's looking at the whole picture.
The whole picture, the trend.
I'm going to try my best to show you what I was taught with this stuff.
Yeah.
So, and this is going to transition us really well into what I really want to talk about, which is seller financing. So let me see if I can get us a better view of my screen. And Dad, of course, I've got the wrong f-stop. All right. Let me know
You
if you
need,
can see.
need some more toys, Christian.
Let me know if you can see the board. All right. So, Dad, I was taught about this on buying used cars, and this is a sales tactic that apparently you're not supposed to use anymore because it's manipulative. But I
No.
like it when evaluating a deal. So the story goes that you would go into your car dealership and they would ask you, what can you afford or what are you looking for? And you say, I don't know, 500 bucks a month. You're like, all
Yeah.
right, 500 bucks a month. We can do that. Sure. 500. 500 bucks. We can do 500 bucks. Of course. The answer is we're always saying yes. We don't want to say no to our
Right.
customers.
Right.
How do they get to 500? We're looking at a $40,000 car. How do you get to 500? Well, I'm going to mess you up on your trade-in. I'm going to extend the number of periods, from instead of 36 months, we're going to go to 72 or 84 months on your loan. Or we're going to, maybe we
Play games with the sales price.
and maybe we backload it. Maybe it's a balloon payment at the end. Or like you said, Dad, we're gonna up the sales price and we're gonna change that. We're gonna throw on a bunch of added fees, or we're gonna increase your down payment. We're gonna say, all right, we'll get you to 500, no problem. Of course, we can get you to 500.
Yeah.
But instead of a 36-month term, we're gonna make it 84 months. You're gonna put 20,000 down, and at the end of it, you're still gonna owe 10 grand. You're still gonna have equity or debt in the deal at the end of the term. So maybe like a negative amortization or something like that. So I think this is really helpful because everyone's focused on one quadrant. What we really need to look at is what's in the middle. That's what we really need to focus on, and why I think that transitions well for us on seller financing. All right. So we talk about the market. We talk about some of the struggles that different price points are having. And see if I can erase my board or not. We're going to do the exact same analysis, but for real estate, because the price is only one term. So let's put that up here. You talk to your buyer and you say, what's your price? What's your price point? What's your budget? And like, I don't know, $1 million. Okay, great. Let's look at 1 million. And what are you going to do? You're going to look at houses anywhere from maybe 750,000 to 1.5, or you're going to be somewhere in that range. And maybe you negotiate hard on the higher expensive properties, and then on the lower ones, maybe you can afford to be more competitive. Maybe you can, maybe it's something that you can afford better. So, of course, we can do 1 million. Of course. What are the other terms that we can play with? That's the fun part, and that's where seller financing can come into play. So, Dad, I mentioned that someone that we know is doing a sale, and her loan is actually assumable. So, Dad, what is an assumable mortgage? What is that generally?
That's a mortgage that you can carry over to you can be the obligor on it. You could be the one who's
It
responsible
can be, yeah, it can be taken over by the new borrower.
by the new buyer.
And so this can be really helpful in an increasing interest rate environment like what we have. So for, 10 years, for the previous 10 years, we were in a declining interest rate environment. No one would ever want the seller's mortgage, their interest rate. No one would ever want that. But when you had a mortgage that was secured back in 2021 at 3 1/8, and now it's at 7 1/8, there's some real value in that mortgage being assumable. So in that scenario, you say that your purchase price budget is 1 million, but I find something that's actually 1.5.
Mhm.
However, the seller has an assumable mortgage at 3.125, which is 3 1/8, as compared to 7 1/8 or 7.5, which is our current interest rate environment. If you can make something like that work and the buyer takes over, you have now taken a $1.5 million property and almost made it as affordable as a $1 million property. So at that point, the purchase price doesn't really matter. It's what is our monthly, what is our cost of ownership? And that could be a real game changer. So assumable mortgage is something that we can really play with. Another thing that we could play with would be seller financing. Another one might be, looking at what the HOA dues are or the insurance. Dad, you and I have had a lot of clients that maybe they're in a golf community or in a high-rise condo with really high fees, but they're not using the amenities. So they're thinking, all right, even if I trade out of this house and get a more expensive home, my insurance could be lower, my HOA fees could be lower or even non-existent. Maintenance could be easier if it's new construction or something like that. So we're looking at the whole picture, and what we really want is here in the middle. What are, Dad, do you have any other things that you look at when trying to figure out what your four quadrants are? You've got
Oh,
purchase price,
if
interest rate.
the buyer is relying on the sale of some other property, this is a perfect opportunity for them not to have to sell their other property during a buyer's market.
Seller financing
So they,
is?
they get the, I would tell people frequently if we didn't have seller financing, the best time to buy is not necessarily the best time to sell. Well, here
Yeah.
they can have their cake and eat it too. It is the best time to buy. There's more wiggle room with the seller. And then, if they can get a long enough balloon period, they can increase the probability that when they go to sell their property, it's a seller's market.
Yeah.
And
Yeah.
they can get top dollar so they can make more money on that end. So it makes it more affordable now. And you want to
So
buy at the buyer's market
seller
and sell
financing looks
money.
like. So there are a lot of rules when it comes to loan origination. I will say, and I'm not an expert on Dodd-Frank. I'm not an expert on some of the Florida regulations around this, but I'll make one kind of broad statement. You cannot be giving people mortgages generally or soliciting, or selling yourself as a lender or an option for a lender unless you have a license as a loan originator. So in Florida, you need a Florida loan originator license to be a lender. You just do. There are a lot of exemptions, and seller financing is one of them.
Yeah.
So a seller who owns the property can give a loan to a buyer. They call it seller financing. It is different than if your neighbor gives you a loan to buy the house in the next town over. It's just different. So we're only talking about seller financing right now. If you ever did want to do the private financing and lend money to people through retirement accounts or whatever it may be, or kind of be available for that, be careful. We got to make sure we read the regulations and get the proper licensing to do
Right.
that. So seller financing. Step number one, you have to be the seller. Makes sense. You
And
have to be the
if it's
seller.
homestead, to tie into your last class, you
Yeah,
might be the seller's spouse too.
that's right. So, um, this is something that the listing agent should think about first. So, it's really hard as a buyer or a buyer's agent to go around town, knocking on doors and talking to open house listings and say, hey, would the seller be open to seller financing? I don't think that's the right starting point. The right starting point really should be the listing agent. The listing agent should have that conversation with the seller and say, let's look at all the options we have to sell your home. What's all the good stuff? What can we use to our advantage?
Right.
Do we have um, a low interest rate, assumable mortgage? That's a value that we may or may not be able to tap into that, but if we can, that's our tool. It's kind of like we've got a, Phillips head screwdriver. Let's hope the screw is Phillips head because otherwise that's just a hammer, in another world. So, do you have an assumable mortgage? Can you offer seller financing? Um, can you delay closing? Can you lease? Do you have a lease in place? Does it earn income? Does it have a new roof? These are all selling points. These are good things. These are things that you think about when drafting your description of the listing. Dad, do you remember when I was applying to law schools, I applied to University of Florida and I got waitlisted. I was pretty bummed because my soon-to-be fiance was going there, and I was like, "Oh, well, this isn't going to work. This isn't good." So I called the dean of admissions and I asked him, I said, "Why did I get waitlisted? What happened?" And he said, "You didn't swing your biggest bat." Do you remember that story?
No, I don't actually. No.
So yeah, it was actually something I've kept for since he told me that. That was in 2007, 2008, maybe 2007, probably. He said you didn't swing your biggest bat when you wrote your articles. You kind of talked about, your LSAT scores. You talked about your GPA. You talked about this. You talked about that, and I kind of
Yeah.
got lost in the shuffle. He's like, yeah, it's nicely written and it was fine. He goes, but what made you special? Why am I paying attention? Why am I reading to the end? You gotta, you can't bury the lead. So that's another thing I learned. Don't bury the lead. Don't put the most important fun part on page three. That's no good.
So
So
what was your
what
lead, Christian?
would you say?
What was your lead? What'd you leave?
GPA. I had an incredible GPA in college. And he's like, you barely talked about it. Instead, I focused on what I didn't have. Because I took the LSAT 3 times because I didn't like the score I kept getting. I took the GMAT 3 times. I took the GRE 3 times. I took the Florida Bar 3 times. Like I apparently I like taking these tests multiple times. But he said, he's like, look, when you talk about yourself, you went to every class, you kicked butt, you did well on all the tests, your teachers loved you. That's why I should have you in my school. Your GPA is amazing. I'm like, okay, all right, and then that makes sense. So don't bury the lead. You're writing a listing agreement. I want to know what our lead is. What's our big thing? It's similar to like the theme of this video series, which is learn one thing. I want to learn one thing about your listing because my attention span is about 10 seconds. In fact, I know all of you have probably signed off at this point. But learn one thing, lead with one thing, seller financing available. I know it has 3 bedrooms and 2 baths. That's, it's in my search terms. I get it, but when I get to your property, is seller financing available? That should be the first thing you write. So let's explain what seller financing is in that scenario. Um, you have to be the seller. The seller has to understand what this is. So the seller cannot have any open mortgages. They have to be able to sell the property free and clear of all debts and then take back some of the sales price as a loan. So let's do an example. Um, Dad, do you have a mortgage?
No,
He doesn't have a mortgage. All right. So I'm going to say, Dad, what is your list price? What do you want to sell your house for?
I don't want to
Hypothetical.
sell
He doesn't want to
it.
sell it. Play along. Give me a price. What's your list price?
3 million.
$3 million. All right, so he's listing at $3 million. He has no mortgage.
Your mother would kill you,
You're
by the
not
way.
you're not going, you're not moving to California to buy another house because that
No.
could be problematic. So the next question is like, what is the seller planning on doing with the sale proceeds from closing? Are they putting it in their pocket? Are they just giving it to their stock advisor? Or are they rolling it into their next home? If the seller is rolling the sales proceeds into the next home, this could be a no-go. Seller financing may not be a good option for them. So we need to figure that out. Or if the seller needs you're selling for 3 million, the seller needs 1 million of that to roll into a condo that you've already picked out. So I really only need 1 million. The other 2 million would go into the bank account. It's like, all right, well, maybe seller financing works. So let's look at that. How much how much does the seller need after closing to do what they want to do next? Are they buying a business, buying a boat, traveling the world? Do they need to be gone? Do they have
Yeah.
an illness? Are they elderly? If you're in your 90s, you're probably not doing seller financing. You're probably not all that focused on it, unless you're prioritizing selling the home and less about when you get your money. You just
Today's
want to be
Wall
on.
Street Journal, Christian, talked about people in my age group, and what they're doing is they're selling and then renting. So they can move around and try different parts of the country. They can go live in Portugal for a year. They can go live in, go back to Cape Cod where, your mom grew up.
Yeah,
You can
I
move.
love that.
We don't need the big house. You can just move around.
I think that's really cool. Owning your own home is a privilege, but it's also a chore.
A lot of
A
maintenance,
lot of work, a
keep
lot of
the
maintenance.
HVAC and all that stuff. So that's the front page of today's Wall Street Journal.
Makes sense. It makes sense. All right. So let's say you were planning on doing that, and you're like, Christian, look, my sale price is 3 million, but really, I'm not going to buy something else. I want to be able to start the rest of my life. I want to be able to do that. So put together your offer. Seller is open to seller financing. That's what we
Hmm.
would say. It would be on the first page, first sentence of your listing description. And so it's like, yeah, we would be open to seller financing. Seller financing is available, or, assumable mortgage is available. So now we have to think about the buyer. So, buyer. what does the buyer need? What does the buyer need? What are their challenges? What gets them over the hump? What makes this property worthwhile and spending some time on? So let's assume the buyer's interested in your property, Dad. The 3 million, it's you're asking a lot, but okay,
Mhm.
I'm interested. But I don't have what I need tax wise to get a loan down at Bank of America. I just don't have it. They want 2 years of tax returns, but I'm a new business owner and I don't have that yet. Or maybe my credit is really bad. I've got a 400 credit score, and so no bank will ever give me money. Or I'm going to be, renting this property out, and so I don't qualify for a
Yeah.
conventional loan or an FHA or something like that. Like this, for whatever reason, this doesn't really work. Or maybe the buyer's like, look, I've got my house in San Diego that I'm trying to sell. It's on the market. Um, and I don't want to wait. I want to be able to buy yours, but the bank won't give me a loan because my debt to income ratio, because of this other home or whatever it may be.
Yeah.
So the buyer has this obstacle that they need to kind of get over. And so now, as the buyer's agent, just like the listing agent did, you're looking at it and saying, what do we really need to get a deal done? How do I kind of take away the buyer's excuses for not moving forward with something like this? So
Well, the
you have to
selling
put
point to
together an
somebody in
offer.
my age group, Christian, would be I don't have to sell any stocks right now, and then have all that capital gain and whatnot. I don't have to sell my house at a time when it's a buyer's market. I can wait till it proves to be a seller's market. So it's perfect. I can buy when it's ripe to buy and sell when it's ripe to sell. I,
Right.
I can liquidate stocks when I'm in a lower bracket. I can play games with my taxes.
You keep saying your age bracket. How old are you? Don't answer that.
108.
108. Okay, so all right, so now we've kind of gotten to this point where the seller is open to seller financing. What do I do next? What you do next is you have to put together an offer. So let me see if I can share.
Are you putting together the offer, or are you going to make the buyer do it?
The buyer has to put together their offer.
Okay.
It just doesn't really work. I mean, all the listing agent has to do is answer, is the seller open to seller financing or not? That's
I
usually
want
the
to know
first.
how much, like out of the 3 million hypothetical, how much of it are you willing to finance?
Well, you really don't know. So it goes back to the four corners.
Yeah.
It doesn't, there's no perfect answer, even if you think you know the answer. I do have a client at the moment, and she's willing to do seller financing, but she needs at least 50% of the sales price now so that
Yeah.
she can go do what she wants to do. She wants to buy something else. So to her, the most important part is twofold: maximizing the sales price and then getting at least 50% as a down payment so that she can move on with her life. And then she'll make an income off of the rest of it if that's what the buyer needs. So we're going to start with a sales contract. You can use any sales contract here. I picked, I don't know if this is my favorite or not, but it is a NABOR as is. So in regards to NABOR contracts, this is my favorite one.
Could I throw a wrench at you right now, Christian? Because it will feed into how you present this.
Good.
A lot of times I'd get people who would put up an additional property along with my seller financing. So they'd put up some other property that they owned, or you put something in there that they're willing to, it's subject to them going and get a equity loan against their home up north.
All right, hold that thought because that goes to how you evaluate the offer. So we'll hold that for just a second.
Okay.
Listen, now we're the buyer's agent. We've got our contract. We're gonna put our purchase price. We're gonna put our deposit, and then right here, proceeds of seller mortgage. This is where you would put the amount of a loan that you want the seller to finance. So if it's a $3 million deal, Dad, I'm going to put your 3 million here, but I want you to give me a mortgage for half of it,
Right,
1.5. And then the balance would be due here minus the deposits.
right,
The next thing you would do is you would go to the financing, line 82, under this contract at least, and you would choose seller financing. The addendum to sales contract seller financing is attached here too and made a part hereof. So you would check this box You would then go down and you're going to check one other box, which is line 507, seller financing. Now, FARBAR does the exact same thing. It has these check boxes. You're going to check it for seller financing and you're going to attach the addendum. So maybe the forms are a little bit different, but it's going to be the same process. Then we are going to pull up seller financing. Let's see where I have that. Addendum sales contracts, seller financing. Can you see that addendum, Dad?
Yeah, can see it.
All right. So FARBAR has the exact same form as this. FAR has one as well. Let's read it. So you've checked the boxes on your sales contract. Now here, keep in mind, there is no one way to do this. It goes back to the four corners doctrine.
Right.
It's how much are you asking them to finance? What is the purchase price? And then what are the terms of the loan? And, the rest of the package. When are we closing? And who's paying for title insurance or whatever else it might be.
Yeah.
So if I used to, and I still say this a lot, there's price and there's terms. Usually you're getting one, you're probably not getting both unless it's a true extreme one-sided market. So in COVID, sellers got everything. They got price and terms, no contingencies, full price, over asking. But outside of COVID, that doesn't really happen often. So if we go in here, we're going to skip to the good stuff, what you need to do. At closing, buyer shall execute and deliver to seller a negotiable note payable to seller in the principal amount of blank. This will match the amount that you put on page one. So if I'm asking for 1.5, I'm going to put it here. And a purchase money, most of the time we're going to say first mortgage in the same amount encumbering the property to secure repayment of the indebtedness. Now, Dad, what is the difference between a note and a mortgage? Aren't they the same thing?
A note is the IOU. I promise to pay Christian Ross a dollar. It's negotiable. I can sell it to my Qs for 50 cents. The mortgage is a lien against the property that secures
Right.
that.
It evidences the existence of the note, but the
Yeah,
mortgage is just the lien, and that gets recorded at the county. So up until this point, what we're saying is that you're going to sign a note promising to pay me back at 1.5 million,
right.
and then it's going to be secured by a first mortgage in that same amount, 1.5 million. So you're going to sign a note, you're going to sign a mortgage right at closing. Now we get into the good stuff. If the mortgage is a second mortgage, default in the terms of the first, da 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 da, we'll skip that. Interest shall accrue on the outstanding principal balance due under the note at a rate of blank. What is your opinion on interest rate, Dad, on these kinds of loans?
Yeah, depending upon the buyer,
I'll
some
stop
people,
there. It depends, right?
it depends.
It depends. Again, it's four corners.
Right.
If if you're financing 100% of this sale, then you should probably get a higher interest rate because it's risk reward. You're going to get a greater reward because I'm paying you 12% interest, but you're taking a much greater risk because I'm not putting in any of my money at closing. There's no down payment. However, if I'm putting 50% down and I'm giving you full price, full asking price, then maybe it should be a 5% loan. I learned something at the prosecutor's office when I was interning there. When they would prosecute white collar crime, because that was the department I was in,
Right.
they would start at 10 years, and then depending on the mitigating or aggravating circumstances, they would go up or down. So if it'd start at 10, if it's really bad, we'll go to 12 or 14 or 20 years. But if we'll start at 10, and if, oh, well, they limited damages, they paid back their victims, they made a full life change, and whatever, maybe we go down to 6. That's how we're going to do this. We're going to weigh mitigating and aggravating, risk reward, all that stuff. So on this deal, Dad, I'm putting 50% down. I'm giving you full price. If I were to go to Bank of America, they'd probably charge me 7% on a mortgage right now. So would you take 5? Right? That's what I'm going to think. And Dad, you're going to figure out whether you're going to do that, but not necessarily on the 5. You're going to look at the whole picture.
The whole picture, whether I'm paying buyer broker compensation, are you going
Well,
to
and this part, how is it amortized? What are
is
the
it
other?
I amortize over, it's when it balloons in my head. When am I going to get my money?
Yeah, so if you go to Bank of America, they're going to give you a 30-year mortgage because that's
Right.
their business, that's what they do. But you're not Bank of America, Dad. You probably want your money in 2 years, 3 years, 5 years. I would say most sellers don't do longer than 5 years. Usually it's 24 months, 36, maybe 60 months. But this also matters. What are the payment terms? So if we keep going down, are we paying it monthly, quarterly, semi-annual, annual payments? Are you going to pay, am I going to pay you the 5% January 1st of every year, the whole thing, the whole year?
Right.
Well, in that case, maybe 5% is good. Maybe that's a good deal for you. And then am I paying principal and interest or am I only doing interest? So on a $1.5 million deal, 10% would be 150,000 in interest payable on day one. Maybe you accept that. Maybe that's a good thing for you. Um, it just depends. So it depends what side of the fence you're on. Are you buyer? Are you seller? Depends how much you're offering. I would just say keep in mind how much you're really asking.
You
So
want it
Dad,
to look good to the buyer, but you want to be able to get the money back by another portion of the contract.
totally, totally. And you don't want to be unrealistic. I remember anytime I would have a job previously, the bosses would say, "Hey, let's do something fun. Let's have a fun committee and you guys plan it out." And they'd be like, "Let's fly to Colorado." I'd be like, "Yeah, that's not happening. Why don't we just go bowling down the street?" So it's like, you know, I guess you don't get it if you don't ask, but I don't know. It's a little silly. So now we have a sign, we present our offer. The seller makes some counters. Again, four corners. We're going to look at price, loan amount, the terms, any other terms that might be part of our deal. And maybe the seller accepts it or they counter it, but hopefully you get it under contract. The next thing is, well, who drafts the paperwork? And what does that look like for the seller? And how do they evaluate this deal? So number one, my office or whatever attorney you're working with would draft the note and draft the mortgage. Everyone would review it. The seller can make any modifications, but there's pretty standard templates for this sort of stuff. We use the Fannie Mae, Freddie Mac templates for notes and mortgages, you know, and if we have that addendum filled out, we follow that word for word. It's pretty straightforward. We then record it at closing. So you're gonna have a signed mortgage or signed note, signed mortgage, and the mortgage gets recorded, secured against the property. The seller gets a lender's title insurance policy. We treat them like true lenders. The seller's job is to evaluate risk. Again, risk, reward.
Hmm?
Dad, if I put 50% down and I'm making monthly payments to you for 24 months with a balloon at the 24 months.
Right.
What's your risk? Is that
Zero.
really risky?
I'm praying for you to default. Now,
You
if you
want
were
me
my
to stop
son,
paying. Yeah. And why you say that is because if I
every
don't
$3 million
pay,
house I'll get for 1.5 million. I mean,
well, possibly, right? So if
yeah,
I don't pay, you have the right to foreclose and the house would get sold at auction.
right.
If you're the top bidder, you would get the house
I
back.
get to bid my judgment amount.
You can bid your judgment amount. You probably even go over
I
that
can
if you
go
want.
higher than that if I want to. Yeah.
Yeah. And if someone else outbids you, you get all your money back plus interest, plus fees, attorney's
I
fees,
make
all
out
that
like a
stuff.
bandit.
So you make out
Plus, I
like a
get to
bandit.
keep
You
my
got
house. I get to keep my house and sell it again.
potentially, or you got your 1.5 million at closing. You got another 1.5 million when it got foreclosed on, plus interest, which was the
Yeah.
5% accrued over 2 years, plus all your attorney's fees. Is it frustrating? Is it irritating? Is it maybe outside of your comfort level? Maybe.
It's worth
But
money.
it's worth something. There's a financial incentive to the seller.
Oh, yeah.
Um, but again, it's four corners. It's the whole picture. What's the seller planning on doing with it? Why does the buyer want it? Is a huge part of the risk analysis. If the buyer's doing it because they're just waiting for their home to sell, it's pretty straightforward, right? And you mentioned collateralizing another property that the buyer
Which would
owns.
happen often.
We can do that. You can protect against those kinds of risks. You can layer it on. The more protections you get, the lower the interest rate. potentially. The
Yeah.
less protections you get, the higher interest rate.
I mean, if the buyer is driven by, they're starting a new business, so they can't qualify for a mortgage, so they just want a low payment. You could just have, an annual payment if it's a 1-year balloon at 0%, but you adjust your purchase price
Yeah.
accordingly so you get the money back.
All right, so we got a couple of questions and we'll end for today. I think this was kind of a fun topic. Darlene asked, what's the percentage of assumable mortgages that still exist? I thought those were from days gone by. Dad, you asked this same question.
I did.
Um, every FHA and VA loan is assumable. Every single one of them. It's right in the loan papers. It's actually very inexpensive for a buyer to assume it. I would say it's similar to like a short sale experience because the lenders are so slow to approve them. They're not that motivated to approve it because they don't make much money on it. Maybe the lender makes $500 or $1,000. So what should be a 3-week, 4-week process ends up being 60 days. So time is a big part of this, but there are a lot of assumables. The trick, the buyer has to be approved in the same way the original seller did. So the seller had to go through the whole approval process. They had to run credit, they had to provide tax returns and all of that. So they have to be approved for that exact same mortgage, debt to income ratio, credit scores, all of that.
Well, what if it were your mortgage and the interest rate is just incredibly low? I mean, can they try to renegotiate the interest rate, the new buyer?
Um, well, my mortgage is not assumable. So I have a conventional loan
But if
and
it
it's
were,
not,
I mean,
what'd you say?
if
If it
it
were.
were,
So if my mortgage was assumable, the buyer would, they would want to know that and they would make an offer contingent on assuming the seller's mortgage. At that point, you're not going to be able to negotiate with the lender on changing the interest rate. Um, I've never seen that. Now, I'll say I've only done, maybe a handful of these assumable closings. Every one of them has closed, but they're rare. They just don't happen
right.
because of, if the seller had their choice, it would just make it a cash deal, obviously. But every FHA and VA loan, the trick with VA loans is that the seller doesn't get their VA benefit back. So if the seller was hoping to buy
Another
another
mortgage.
home after closing using their VA benefit,
Yeah.
this is a no-go. So most VA loans, you're not going to do an assumable. So stay away from it in that case. But there are a lot of them, and the seller can get all that information. They would give it to the buyer. You make your deals contingent on that. And then Yvette asked, why would a seller want anything less than what the bank wants in strength to pay? I have a friend that says anyone who needs seller financing is the worst borrower. She also says, Dad, you're in your prime, even though you're 108. That's good. All right, so this is a great question.
Tell your mother.
This goes to risk analysis and what kind of lender you want to be. So
Use me as
most
an example, Christian.
most conventional lenders, most Fannie Mae, Freddie Mac lenders, they have
Yeah,
to follow the Fannie Mae, Freddie
yeah,
Mac guidelines. They have to go and check your credit. They want to check your debt to income ratio. They want
right.
to check your assets and your liabilities. And sometimes you get denied even though you can afford to pay back the loan because the lenders have to follow those guidelines. You can, as a seller, you don't have to follow Fannie Mae guidelines. You can do whatever else you want. If I'm getting 50% down, I don't really care what the buyer's credit score is. Maybe I do, but not really.
I
The
really
most
care. To further that, with the stock market being the way it is, if I came into a boatload of money, it'd be in 3-month treasury bills right now, rather than more equities, more,
Yeah,
Amazon video, stuff like that, until things settle down. So it's a nice short-term thing for me, especially
it
if it's
could be a
1-year balloon or a
financial,
2-year balloon.
yeah, it could be to the seller's benefit
It's
to
part of the
my
portfolio.
sale price.
I got this thing coming. I can tap that for cash before I have to sell stocks or anything else. So it balances things out, and it's secured by real estate, so it's a really safe investment. It's not like a stock that can be belly up tomorrow.
Exactly. Couldn't agree more.
So it's in context.
You now have the idea of why seller financing is interesting. You have its, twin sister, assumable mortgages. You know how to evaluate these kinds of deals or just real estate deals in general, price, terms, the four corners.
Yeah.
You're looking at the middle, the core of the deal. Okay, the price is high, but the terms really stink. I don't get my money for 20 years.
Can I
Um,
add something here, Christian, that comes up a lot? You got to be real careful who's going to be signing the mortgage and note. The buyers try to get cute, and they might have all their investments in, say, husband and wife, and the contract's coming from just one of them. You want individuals, both of them, who, in all probability, are the
do
co.
you? Do you? What if what if you're only giving a 10% loan? Do you really care? I dare you to terminate or to foreclose. I dare you. So maybe, Dad. The people who you're lending money to always matters, of course.
Be
How you
cognizant.
set it
I
up,
mean,
personal guarantees, checking for why they're needing this loan. All these things are very relevant. But I'll leave you guys with this. A couple weeks ago, we had a closing, and the buyer wanted more time. And the seller, his question was, why? Why does he need more time? Why does he? I need an answer. And this seller he was being difficult. He was tough. And I
no.
said, why do you care? Why do
Yeah,
you care? It doesn't matter. It really doesn't matter. Maybe in a far distant world. Now, the context is that the buyer wasn't really talking much. So we weren't getting any context. So I was like, yeah, I'd love to have that information. But at the end of the day, I don't care why the buyer needs this
yeah,
time. What I care about is what am I going to get for the extension? I want the deposit made to me today, and I'll give you an extra week extension. I don't care. I don't know if are you having a medical procedure? Are you in a fight with your spouse? Are you just retarded? I don't know. It doesn't matter to me. I probably shouldn't have said that. It doesn't matter to me. What matters to me is what are we going to get for the extension? I
yeah,
want to get something, and in return, I'll give you your extension. And ultimately, that's for the seller to decide. It's for them to figure out that risk reward analysis. The seller disagreed with me, which I thought was fine. Um, and so what happened is the buyer gave us an answer. He's like, "Oh, well, I'm just waiting for my other closing." And the seller's like, "Okay, well, then I'll give you the extension." Well, he didn't fight for the deposit. He didn't ask for it. And guess what? The buyer never closed. And so he never got the deposit, gave him the extension anyways. He got his answer, but he still got left holding the bag at the end. So to me, the why sometimes doesn't matter as much as what am I going to get for it? Look at the deal on your side first. Try and understand as best you can on their side. If it all adds up and you get a good feeling and you can take that kind of financial risk, we do a lot of these. I would say one a week. We're doing about one a week
yeah.
right now.
Done a ton of
Really
them.
common. Dad, thank you. Everybody, good luck. If you need help on this sort of stuff, just call. Good luck,
All right,
everybody.
take care, Chris.